we picked out 5 niche investments that we've made over the last year that we think really are outperforming everything else
Right.
out there. So, Denny, let's dive right in. The first one here,
Let's do it.
property tax abatements. We've actually done a bunch of these over the last year or so. And we love these for a lot of reasons, but the way these work, for anyone who's not familiar with property tax abatement real estate deals, is the operator will go out and they will buy a multifamily property, be like an apartment complex or whatever, and they will partner with the local municipality on setting aside some of those units for affordable housing. And the mechanics of that vary, based on the jurisdiction, but in most cases, it's a those units are set aside for people earning less than a certain percentage of the area median income.
Now, Brian, is this Section 8?
No, it is not Section 8, although we will also talk about a very niche Section 8 strategy in a minute. So I'm glad you brought that up. But this is not Section 8. This is just units that are set aside for people of lower or moderate income. Like these units cannot be rented to high income renters. They can only be rented to people earning less than a certain percentage of the area median income. And in exchange, the operator gets a property tax abatement. They either get their entire property tax bill waived, or a big percentage of the property tax bill gets waived. So there's an instant cut in expenses for this property, which in theory lifts the NOI, the net operating income, which raises the property value.
It
Uh,
also raises occupancy, correct?
it can, if this is all done right, this should boost the cash flow for the property and boost the property value. And when I say done right, operators who we've seen do this in the co-investing club, they will buy properties. They're already renting units to people who meet these qualifications. So there's little or no loss in rental revenue from making this agreement with the municipality. But there's a huge cut in costs and expenses because they don't have to pay property taxes anymore, or at least a big chunk of the property tax bill. So this is a way to boost the cash flow and boost the property value overnight, basically, like day one of buying the property, without having to swing a single hammer, right? Without having any of that construction risk that comes along with renovations and
Or deal
forcing.
with inspections, like the
Oh yeah,
government inspections and all that
yeah, when
paperwork.
you renovate, one of these big apartment complexes, yeah, you're gonna have to pull permits and deal with inspectors, and sometimes you get behind the walls and you discover other problems you didn't know about. So yeah, there is absolutely construction risk, construction headaches when you do a traditional value add uh, deal with renovation. This is a way to add value without renovation, and we've also seen some operators combine this with renovations. So yeah, it's a great strategy. We have found this to be low risk, high return. It's a great niche strategy for people who know how to do it. All right, moving on to number 2, a niche strategy called Section 8 overhang, which is something that Denny, you and I learned about for the first time. The first time that we talked to an operator who was doing this, which was not that long ago. I don't know, what, a year and a half ago. Um,
About that, yeah.
yeah, so it's a really fascinating and ultra niche strategy where an operator will go out and they'll buy a property with the low income housing tax credit, LIHTC for short. And the way the LIHTC works, so you get this great tax credit, which is wonderful for the operator and for passive investors like us. But LIHTC comes with some restrictions, and specifically, it restricts how much money renters can come out of pocket to pay rent towards this property. And again, it has to do with like local area median incomes, and so there's a restriction on that. So for most LIHTC properties, that means that you have to charge below market rents. And that, of course, impacts the value of the property. It means that the property gets sold for a lot less than what it could be sold for if it were renting at market rents. Um, because that's how commercial properties are valued, right? Based on cap rates, which are based on uh, the NOI, the cash flow for the property. So this Section 8 overhang strategy involves going out, buying a LIHTC property. So you get this great tax credit that comes with it, but you're buying a property with below market renters and below market rents. So what they do is, as those leases expire, they will either work with the tenants to get them approved for Section 8 and start getting paid by Section 8, or those tenants will move out and they will replace them with new tenants who have Section 8 vouchers. And the reason why this works is that now they can collect full market rent, or in some cases even a little bit above full market rent, because the tenant's portion of the rent falls below the LIHTC restrictions, right? Because this is a loophole, because LIHTC restricts what the tenant pays, where the tenant comes out of pocket and pays. But if Section 8 is paying 2/3, 3/4 of the rent, then the tenant is paying way less than what LIHTC allows.
That's a
So
win-win.
yeah, it's a win-win. So not only do you bump up the cash flow, again, basically overnight, as these leases expire, you get full market rent all of a sudden. That also bumps up the property value. So you can turn around and sell this property, a couple years later after, having replaced all cash paying tenants with Section 8 tenants. And you get, full market value for selling that property. The LIHTC, the tax credit's intact. And you have most of the rent paid by the government. So it's guaranteed
Right.
rent. So yeah,
And
win-win.
nothing will sit vacant for long at all because there are waiting lists.
Absolutely. And there's some recession resilience built into both of these strategies, right? The property tax abatement strategy and the Section 8 overhang strategy. Because in a recession, these types of units become that much more coveted, right? At least for the property tax abatements. And for Section 8, the government's, again, paying the rent. So, you don't have the risk of the tenant just saying, "Oh, I can't pay the rent this month, sorry," and forcing you to evict them for 6 months. All right, moving on. Number 3, mid-range land flips. So Denny and I we've featured a couple different land investors in the co-investing club over the last year or so. We're actually getting ready to bring one of them back because his land flipping fund has done so well. But this operator, who we invested with a year ago, and we're about to bring them back and feature them again in the co-investing club, they specialize in mid-range land flips. So they're not buying the super cheap land parcels, the $5, $10, $15,000 land parcels, that got really popularized during the pandemic, for everyday people to go out and try to flip land. He's buying parcels between $25,000 and $250,000 a parcel. So, it's above what your typical like dabbler is doing, but it's below the institutional money. So, he's not competing with institutional investors for these land parcels, and he also isn't competing for the most part with the sort of part-time dabblers. Denny, you and I dabbled in it for a little bit. It was fun, and
Yes.
we made some money. But ultimately, we decided it was a distraction from our main business, the co-investing club and Spark Rental. So we stopped doing it. But this guy has found a really great niche here with mid-range land flips, where there is not a lot of competition. His particular strategy, he will do these simple, what's it called?
Splitting
Simple
splitting up
subdivisions.
the right,
Um,
which is so
where
cool to me.
Yeah, it is. So he operates in counties that allow him to subdivide up to 5 lots per parcel that he's buying without having to get special zoning or permits for it. So there's no zoning risk, right? It's not like he's going to buy this lot planning to subdivide it only to be denied by the county. He can do this, yeah, and there are certain specifications like minimum lot size and all that stuff. But he can buy these parcels knowing in advance that he can then subdivide them and sell them off as individual lots for people to build homes on, or use for recreation, or put their mobile home on, or whatever. So he has found a way to add value, and of course he's buying these for pennies on the dollar as well.
Right.
He's typically buying these for 35 to 60 cents on the dollar. So he's making money several different ways. Sometimes he'll do a little bit of minor improvements, like maybe he'll add like a dirt access road or something really simple. But yeah, simple subdivisions with mid-range land flips has been a winning niche strategy as well. And that particular fund, that land flipping fund, has been paying 16% distributions like clockwork. It's been amazing.
Yeah,
Uh,
it really that it's one of my favorites.
Me too, and I'm excited to bring him back. I'm excited to invest more of my own money in that fund because it's been great. All right, number 4, prefab home placements. So there's another land flipper who we have invested with, and he has another niche strategy where he goes out and he will buy a buildable lot that is vacant, right? It's vacant land, but he knows that it's buildable. It's either it has a hookup for public water and sewer and electric, or maybe he knows that he can drill a well really easily. Or that actually no, I think he only does stuff with public water and sewer and electric, if I remember correctly.
Yeah, I
Um,
believe you're right.
yeah,
Yes.
because he's not drilling wells. um, so anyway, he buys this lot again, pennies on the dollar, and then he will install a manufactured home on it. Now, a lot of people when they hear the term manufactured home, they have misconceptions. They're thinking like old school, like
Trailer.
cheap trailers. Yeah,
Yes.
manufactured homes are quite nice. They are permanently affixed to the ground. They're on a foundation. Like it's a permanent home. Um, and nowadays, like manufactured homes and modular homes can be very nice. I mean, I have a friend who owns a multi-million-dollar modular home, and
Oh,
you'd never
wow.
know. I mean, the thing's it's got 3,500 square feet or something.
Multi-million?
Yeah, yeah. I mean, he's quite successful, as you can tell.
I
um,
just never heard of that in a
but well, he
modular
built he
home.
built it from the ground up, and nowadays this is how most or a lot of homes are built. So they'll each component of the house is manufactured, and then they fit together like Lego blocks, basically.
Oh, right.
So I mean, this he has this very impressive and gorgeous home, um, and it's all brand new. But it was kind of the different rooms and pieces were kind of fit together. Um, but anyway, manufactured homes can be quite nice, is the bottom line. And this land flipper will then sell that home to a home buyer, a first time home buyer, for literally half the average median home price. So in that market where he primarily operates, median home price is $460,000. He is selling these for $230,000, and they're nice
They're
homes. They're
nice.
pretty homes.
Yes.
Full, I mean, yeah, full everything. Um, but he's selling them for half the average home price. So there's never going to be a loss in demand for that, right? Like even in a recession, people are still going to want to buy homes for at half the cost of the going rate nearby, right? So anyway, he's had a lot of success with that. We've had fun investing with him. Excited to keep investing with him. All right, number 5, industrial seller leasebacks. This is
Mm.
another, deep, weird niche that we've had success in, or at least not us personally. We're not out there buying these ourselves, but we are passively investing in these kinds of deals. So we did one of these earlier this year where the operator, they specialize in this one narrow niche. So the industrial company, they own the land underneath their factories and buildings, right? They want to raise money to expand their business and grow. So they could take out a loan, but they instead decide to sell off their real estate holdings and then lease them back from the operator. So this provides several protections for us as investors. So for one thing, the operator runs the numbers and makes sure that if this seller and soon to be tenant defaults on the rent, they can just evict them and put a new industrial tenant in there who's going to pay more, right? That there's market demand to actually pay more rent than what this seller leaseback tenant is paying. So that's one protection. And they do deep due diligence on this industrial tenant to make sure that they're super stable and going to keep paying the rent for many years, and then eventually buy back the real estate. So in this particular deal, it was a metalworking company whose primary client is actually the U.S. Navy. U.S. Navy is obviously not going
That's
anywhere.
good.
Yeah, and they had a backlog of orders through 2028. And this was at the beginning of 2025 when we made that investment. So even if not a single new order came in for the next year, they're still backlogged for 3 years out. I mean, yeah, it's
That's
super
crazy.
impressive. 4 years out, actually, from that point. So yeah, a very stable deal. That started paying distributions basically right away. Actually started paying distributions early. It wasn't projected to start until after a quarter or two. And like month one, they basically started sending out distribution money to us, which was great.
Yeah.
So yeah, quick summary of the 5 ones that we just ran through: property tax abatements, Section 8 overhang, mid-range land flips, prefab home placements, and industrial seller leasebacks. We've seen all of these perform really well as passive real estate investors. Denny, anything that you
And
want to
it
add?
helps, well, it helps diversify. So when you have something like these that are a little bit different, it diversifies, the regular ones. And in these days where the market is a little crazy, it's good to have that.
Yeah, and that's a point that's worth reiterating, that we as passive investors, we want to, and especially investing smaller amounts in the co-investing club, we're investing 5 grand a person, even though collectively we're investing 500,000 at a time, or whatever it is that month. But we want to go shallow and wide, right? Like we want to have many different investments in many cities and states, and different asset types, different operators, different timelines, investment timelines. We want massive diversification, but each individual investment we want to be narrow and deep, right? With like a super deep niche, an operator who does like one thing and does it really well, like we just talked about.
Hmm.
So anyway, on that note, guys, if you got something out of this episode, if you got a fresh perspective, please share it, pass it along to friends, families, neighbors, colleagues, all
Hmm.
that good stuff. Follow us, subscribe to the show, and
Send us ideas
please do
that you
support at
want to hear about.
sparkrental.com. Yeah, let us know what you want to hear more about. And if you're not that familiar with passive real estate investments and how they work, we have a free course on them, sparkrental.com/free. We walk through things like syndications and private notes, private partnerships, equity funds, debt funds, all that stuff, and make it really simple. And I would like to think fun. It's super quick videos, like 5 to 10 minutes a piece. And on that note, stay weird, unconventional investor.